All right, everyone. What's going on? What's going on? Everyone watching the recording, everyone joining up the stream here. In the meantime, let me start this up real quick. Hold on. Let me make sure this is going live and everything's looking good. And we go from there. All right, there you go. All right, we're live. We're live. All right, blah, blah, blah. Okay. So, welcome everyone. Welcome, welcome, welcome. Here, let me go ahead and put this out real quick on the Discord and all that good stuff. All right, there you go. Let me start. Let me start this call up real quick. Give me 1 second. All right. Here, let me make sure everything's looking good. Hey, what's up? What's up, everyone joining up? What's going on, guys? What's up? What's up? Real quick, can you guys hear me real quick? Or wait, here, let me see. Hold up. Let me make sure everything looks good here. All right, there you go. There you go. Okay, perfect. Let me make sure this is looking good on. Okay. Hey, what's going on, guys? What's up? What's up? What's up? What's up? What's up? What's up? Here, let me go ahead and add everyone real quick that I started the call real quick. Um, what's up? Hey, what's up, Mohammed? What's going on, my man? Hope everything is going good. Here, let me go ahead and start this up. All right, bet. All right, what's up, everyone? What's going on? Okay, so what are we reviewing today? Right? I've been getting a lot, and I mean a lot of DMs. Cause lately people have been asking me for payout or like to show my payouts. So I'm like, all right, sure. So this month, guys, it's been definitely been a crazy month. I ended up getting two payouts, or well, I got one payout, and I just requested another one this last Friday, for about $20,000 this month, right? And I get a lot of DMs saying like, bro, how do you do it? You know what I mean? If I start with 500, can I get a consistent 3K month? Do funded accounts. Do funded accounts. 500 won't get you too far if you're just starting off with just 500. So just do funded accounts. It'll be a lot better, right? So, guys, I've been getting a lot of questions lately. Hey, what's going on, everyone on YouTube, by the way? I've been getting a lot of questions lately on what strategy do I trade, how do I get these payouts, and how can you use it so you guys can get funded and, of course, get your own payouts. Explaining funded accounts, that's a whole different class. If anything, just search up a video on it. It will explain it for you. You're just pretty much trading with money that's not yours. What's up, Brizzy? What's going on? What's going on? All right, so let's get straight into it. All right, guys. So here, let me go over to my YouTube. Make sure everything's looking good here. All right, perfect. Okay, so let's start. All right, so I'm sure you guys know what my strategy is. For the people in the premium at least. But for those that are new, here's exactly what I trade, how I trade it, and so on. Right. So to start off, right, there's four things that is included in my strategy. Right. Actually, three things. Right. So actually four. I got confused there. Okay, so you need to know how to identify these four things in this strategy in order to understand it and actually trade it completely, right? So the first thing, of course, with any strategy, actually, with support and resistance, breakouts, retests, whatever the case may be, you guys need to know what the overall trend in the market is, right? So the first thing you need to know, and it's the easiest thing to know, is the trend in the market, right? That's number one. And I'm going to explain everything from A to Z so you guys can understand it, of course, perfectly, right? So number one is trend. You guys need to understand this, right? Number two is DOL. What does DOL stand for? You guys might be asking. Well, it stands for draw on liquidity, and exactly consistent. Exactly. So you got it, bro. You got it. But okay. So yeah, draw on liquidity, right? Number three is of course MSS, which it's not a must, but it's definitely something that I would highly suggest you guys learn, right? And I'm gonna break it down in this class, so don't even stress it, right? Everything's gonna be all here, all right? So you guys need to know MSS, right? And the final thing is fair value gaps and inverse fair value gaps for your entry point, right? How do you see the trend? I'm gonna show you right now. Right? So number four would be fair value gaps and of course inverse fair value gaps, right? So these four things right here is what allows me to pretty much pay the bills, and you know what I mean, it just pays me, right? So I'm gonna show you guys exactly how easy the strategy is, how not spot on, but how like direct it is. Like it just tells you everything. It tells you the whole story, right? And I'm gonna show you guys exactly how to know what the market is gonna do, when it's gonna do it, how it's gonna do it, and how the market is gonna react, right? So I'm gonna show you guys this right now, right? Okay, let's get started, right? So someone just asked me how do you see what the trend is, and it's actually super easy, right? It's pretty much just knowing, is the market steadily going up or is the market steadily going down. There's three trends, right? There's a bullish trend, there's a bearish trend, and there's a choppy trend. Pretty much what choppy means is that the market is trading sideways, right? There's like, it's not going up nor down, right? So here's what we're gonna do, right? So the one thing you guys need to understand when looking for the trend and the draw on liquidity in the market is going to be this right here. So for example, right, let's say that the market is in a current bullish trend, right? How does a bullish trend look like? Well, of course, it's not going to be only, the trend is not only going to be going up, right? It's going to be, the whole idea of a trend is that the market is steadily going up, right? So how would that look like? Well, there's a million ways that it will look like, but in this case, ideally, the trend would look somewhat like this, right? So here's what it's going to do, right? The market is steadily going up, but you guys might be asking, why is the market pulling back? Well, with these pullbacks, these are known as drawn liquidity pullbacks, right? And I'm going to explain to you guys what these mean, how they work, and how you can use them to your advantage with this strategy, right? And exactly how you guys can make money off these pullbacks right here, right? So in a bullish trend, it could look either like this, or it could look straight up, pull back like this, right? But the overall idea is that the market is going up, right? So pretty much the way you're able to identify the trend is by using these four terms, right? So in a bullish trend, these terms are going to be known as higher highs, and number two, which would be higher lows, right? And I'm sure you guys know about this, right? I mean, it's one of the most common things in the trading space, right? So what do higher highs and higher lows pretty much represent in the market, right? Well, in a bullish trend, pretty much the way you know that the market is steadily going up is because the market is constantly breaking highs and having smaller pullbacks. So how do you find that? What does it mean? How does it look like? Well, in this case, right? Let's say that the market trend is currently bullish, right? How do we know we're having higher highs? Well, because the highs that the market is creating, every single high is higher than the previous high. I mean, it's in the name, right? So notice how the market keeps breaking previous highs over and over and over, right? This is known as a, of course, higher high, right? Constantly, right? So what this is showing you is that the market is constantly breaking new highs, giving you that bullish trend that buyers are in control and they're breaking above these levels of resistance, right? Or these highs in general, right? Now, what do higher lows mean? Well, same thing as higher highs, just the lows, which is also known as the pullbacks, right? These pullbacks, you guys need to pay attention here because these pullbacks are the money makers, right? I'm going to show you guys exactly how to use these pullbacks to pretty much predict what the market will do in the future, right? It's how I do it. I'm sure you guys have seen the commentaries. I'm sure you guys have seen the results of the trades, the payouts, and all that stuff. It's mainly because of this. I'm going to break it all down here, no strings attached, right? So higher highs or higher lows in this case would look like this. So each pullback down here, right, that when the pretty much when the market is in a bullish trend, when the market goes down and it bounces back up, that pullback that it creates, right, will be known as the higher low, right? So it'll be these lines right down here, right? So why is the higher high, or I mean the higher low, so important? Well, okay, so you guys need to understand pretty much the concept behind the strategy that I trade, right? The concept is that, of course, I'm sure you guys have heard of this. Banks pretty much control the market, right? But how let me see, what time frames do you use the strategy on? Any time frame works, but I'll explain that later on once we get deeper into the strategy. And by the way, guys, if you guys do want the recording behind this and live trading and all that good stuff, here, this might be something that you guys might be interested in. Here it is. How much should I put in? That's up to you, bro. That's however much you want to risk. But anyways, okay, so here's the concept that I trade, guys, and this concept is, okay, it's not guaranteed, but it's a big idea that a lot of traders use in the market, including me. What time frames? I mean, just use these, bro. I was gonna explain them later on, but if you wanna just have them, here it is. Okay, so what concepts do I trade in the market, right? Here, let me go ahead and do this. Okay, so the whole concept or the whole idea on what my strategy relies on is that the banks move the market. The banks are the heavy hitters in the market. So what does this mean, right? And how can you trade with the banks? Well, okay, so first and foremost, right, to start off, there is not a person in a bank trading. That's not how it works. It's an algorithm, right? An algorithm is pretty much something that reads numbers in the market, right? So how can you use this to your advantage? Well, it's actually really easy, right? So, okay, when the market is in a bullish trend, right? Here's the whole idea. When the market is in a bullish trend, right? Ideally, 90% of people, they're going to be looking to play with the trend, right? A lot of people trade with, I mean, if the market is going up, it makes no sense to bet on the market going down, right? Or most times at least, right? So when the market is constantly going up, right? People, a lot of retail traders like me, like you, everyone in here is a retail trader. No one in here trades like a bank. You know, no one in here is an algorithm, right? So when the market is constantly going up, a lot of us have the idea that we think that the market will keep going up because everyone is buying, right? And that creates liquidity in the market, right? So let's say, for example, right now the market trend is bullish, right? And let's say, for example, we want to go ahead and buy into this bullish trend by going into longs or into calls, depending on what you guys are pretty much, what's it called, what pretty much, you guys are trading, right? It could be options, it could be futures, it could be forex, it could be whatever the case may be, right? As long as you guys think that the market is going up and you guys are buying into it, you guys are creating liquidity in the market, which is pretty much what the algorithm reads, right? So how can the algorithm read the market? I'm sure you guys have heard that banks can quote unquote see your stop loss. Well, it's true to an extent, right? They're not like primarily focusing on you. They're looking at a big pool of liquidity, right? I'm gonna show you guys what I mean by this in a second, right? And all of this is gonna make sense in a minute, because it's all aligned with my strategy, right? So let's say, for example, you guys clearly see that the trend is bullish and you guys think that the market is going to keep going higher because we broke above this higher high up here, meaning that, of course, we're going to create another higher high on the way up, right? So a lot of people in here are going to start entering longs, in this case, at the breakout, right? Now, I'm sure 99% of you guys, well, I hope so, you guys use a stop loss in the market, right? So when a lot of retail traders like us are placing stop losses, ideally we place our stop loss at the most recent low where the market bounced from, because of course that's where buyers stepped in and that's where they gain the strength to, of course, push the market back up after the pullback, right? So in this case, let's say, for example, we ended up, a lot of us ended up entering off this breakout right here, and we're going to go ahead and use our stop loss at the most recent low, which is going to be this low right here, right? Now, this low is not a random low, right? It's a pullback where the market, of course, where the algorithm or a lot of researchers like us, we made the market pretty much bounce off this level, right? Making it bounce up, right? So what ends up happening is a lot of us start placing our stop loss order into this level right here. Now, you guys need to understand what a stop loss order is, right? Pretty much when you guys enter a trade and you guys say your stop loss, you're pretty much putting an open order, pretty much telling the market you're pretty much telling the broker that if the market goes below this level, I want you to go ahead and sell this order to someone. Now, keep this in mind, guys. It's very important to understand this. The market moves off buyers and sellers. Where there's a seller, there's a buyer. Where there's a winner, there's a loser, right? So if everyone in here, let's say, for example, we all enter longs and we place our stop loss at 19,161, right? What's going to end up happening is we're putting a lot of open orders, meaning that if the market goes below this level, we're all going to be giving our money away to someone buying, right? Now, who's going to be the one buying? Well, in most cases, it's going to be the algorithm. It's going to be the banks because, of course, they have the big money in the market. They have billions upon billions of dollars to trade with, unlike our $100 that we're using. You know what I mean? So in this case, right, when all of us are placing orders into this low right here, we're creating a pool of liquidity and a pool of open orders, which is pretty much also known as liquidity, right? So what ends up happening here, right? Well, let's say, for example, right, the market wants to keep going up like crazy, right? And it's to the point where banks or the algorithm or banks or whatever, or institutions or whatever the case may be, right? A lot of banks are really interested in, of course, entering longs or getting buy orders to make the market go up, right? Now, keep this in mind. Keep this in mind, guys, right? The banks or the algorithm or the institution, whatever, like I said, whatever the case may be, they're not going to be buying with us, right? They're not going to be buying as the market is going up. You guys need to keep that in mind, right? They're not going to be buying with us. They're going to be buying from us or like against us, if that makes sense, right? So what do I mean by this? Well, keep in mind, guys, remember what I told you about the orders being open in the market, which is known as the stop loss, right? Pretty much what this means is that all of the stop losses that we placed at 161 down here, right? Since there is a lot of open orders, of course, the banks, they don't want to be buying up here. So what's going to end up happening? Well, actually, they have the power. Like, the concept is banks have the power to manipulate the market to make price go down into any level of liquidity, any level of drawn liquidity, which in this case will be this one, right? Which is where all of our orders are lying at, which creates drawn liquidity, right? It creates DOL, right? So what's going to end up happening is that banks manipulate the market to go down into these levels of liquidity. It stops everyone out, and of course, where there's a seller, there's a buyer. Keep that in mind, right? So what ends up happening is banks make price go down into this level before going any higher. It stops all of us out, right? It goes maybe a little bit below the level. It stops everyone out. We sell our contracts somewhere in the market, which in most cases is probably going to be to the banks or to the algorithm or to the institutions, right? once the algorithm pretty much detects that there's no more liquidity in the market down here, right? It pretty much pumped all the money into this to where the market will pump right back up, right? I really hope I'm making a little bit of sense. To new people, it might be, you know, like a whole different world of trading, but to those experienced, I really hope it's making sense to you guys, right? So what, like, I'm sure you guys pretty much heard me say earlier that banks can see your stop loss, right? And like I said, they don't target you specifically, right? The market is not out against you. It's out against all of us, right? So what the algorithm can read, like I said, it's a numbers game, right? The algorithm can read huge pool of liquidity, which is pretty much open orders in these levels, right? So of course, if you guys place your stop loss at a very common level, such as a pullback to the high or low, right? Of course, there's gonna be times where you guys get stopped out at the complete bottom, and the market pumps back up or pumps back down depending on what the direction is, right? And I'm sure if I asked you guys in the chat, how many times have you guys placed a stop loss order? It stops you out to the cent, and it goes right back up, right? It's a common thing. Why is that? Well, it's because pretty much the algorithm can read the liquidity in the market, such as a common stop loss, right? You guys, including me, it's happened to me. Of course, I'm not an angel or anything. But I'm sure we've been stopped out to the complete cent and the market just goes our way, right? Sure, it gets really annoying, but that's just how the market works, right? So how can we use drawn liquidity and how can we use retail traders' common stop loss to our advantage, right? Well, this is where the MSS model comes into play, right? So right now we pretty much covered what trend is, and we cover what drawn liquidity is, right? Pretty much what drawn liquidity is highs and lows before a pump or a dump, or also known as a pullback, right? And of course, a trend is whether the market is going up, whether the market is going down, or whether the market is just chopping out sideways, right? So now that we have that, right? How are we able to identify the MSS model, right? Well, keep this in mind, guys. Like I said earlier, right? Before the market does the actual big move, it's kind of rigged against you, right? It's going to make sure that it stops everyone out and everyone fills their orders over to the banks before the big move happens, right? So we're going to be using this information to our advantage, right? So how do we do this, right? Okay, let's say for example, right? I'm gonna create a whole new example right here, right? Same example as the trend and drawn liquidity, but just a different chart, right? So okay, and I'm gonna test you guys real quick. I wanna see if you guys are understanding this, right? So let's say for example, right? Let's say for example that the market created a, let me see, hold on, let me go like right here, right? Let's say for example that the market created up here a level of liquidity down here, right? And let's say for example that, let me see, the market trend is bearish, right? Let me see if I can make a good example. Actually, no. Let's say that's bullish, right? So let's say that the market trend is bullish and we have drawn liquidity right here, right? So let me test you guys. What would this down here be known as? Let me see. Drawn liquidity. Okay, exactly, Alex. It'll be known as drawn liquidity, right? And I really hope that you got everyone else understood that, right? So in this case, let's say that the market trend is somewhat bullish, but we have a bearish level of liquidity down here, right? So how can we use this into our advantage? Well, let me go ahead and mark this out as drawn liquidity. So in this case, let's say for example that we have drawn liquidity up here as well, because keep in mind, guys, the market will always have a high and a low unless it's trading at all-time highs, which is not usually the case, right? Let's say that up here we have drawn liquidity. So one thing that I always tell my students that I mentor and I teach and all that stuff during the live trades, is that I tell you guys, drawn liquidity, think of it as a magnet concept, right? Think of drawn liquidity as a magnet, pretty much. And the reason I say think of it as a magnet is because keep in mind, right? There's a lot of orders at these very common levels of liquidity. So what ends up happening is, of course, banks want to go into these levels of liquidity and take them out, right? So it's think of it as a magnet. Like banks are using these levels as magnets. It takes them out and then it does the complete opposite, right? And in this case, here let me okay, yeah, right. Let me see. Drawn liquidity is your TP zone. Yeah, usually. So you could use drawn liquidity to pretty much identify what the market trend is, where the market will go to, or you can also, if you enter a position, you can also use drawn liquidity as your take profit. And I will explain that in a second. It'll make a lot of sense in a second. Do you think it's gonna hit an all-time high today? No, bro. We're nowhere near all-time highs. I don't know what chart you're looking at, but NQ is nowhere. At least what I trade is nowhere near all-time highs. But anyways, okay. So here, let me close the. You guys got any videos you can recommend? Yeah, here. Here, all my videos will be here. To my classes and all that stuff. There you go. Okay, so let me keep going. Right? Okay. So let's say for example, right? Let's say for example right here that the market trend is currently bullish, right? We created this low, right, which creates drawn liquidity, right? But we also have a really big rejection up here that also created drawn liquidity, right? Meaning that the market found a high up here, right? Up here at where the drawn liquidity is, right? And it dumped back down. So think of this as a pullback or a huge rejection as the market was dumping down, right? So what ends up happening here right here? So let's say right here that we have drawn liquidity, which is acting as a magnet. So we know that price is going to go into this magnet up here, right? So right here, price finally broke above drawn liquidity. So what can end up happening here? And keep in mind, guys, the 4-rule strategy, or the four things that I look for in my strategy. Right here, we're going to look at step 3, which is known as MSS model, right? So before I do that, here, let me go ahead and put this as a magnet. Think of it as a magnet. Right, so price was in a bullish trend. We took out this drawn liquidity. What can we expect next? Do we think that the market will keep going higher, or can we expect a sell-off even though the market trend is bullish? How do we know exactly what the market will do from here on out? Right, well, it's actually super easy, and it's easy thanks to the MSS model right here. So what does MSS stand for? Right, simply it stands for it stands for market structure. That's spelled right? Yeah. Shift, right? So what MSS stands for is market structure shift. What does this mean? Right? What does this mean? Well, it's actually super easy. Pretty much what this means is, let's say for example, the market trend is bullish, right? We take out liquidity, which we did in this case right here, right? What ideally you would want to expect, or what you would want to look for, is a simple reversal, right? It stands for market structure shift. It's pretty much the structure of the market shifting. I mean, it's in the name, guys. Come on now, right? So right here in this case, we know that the trend is bullish because we're creating higher highs and higher lows. We know this because the market is constantly creating, of course, new highs, and it's steadily going up, right? So what can we take from this case, right? Pretty much what MSS means is the trend going from being bullish to being bearish, or from being bearish to being bullish. It's pretty much just the trend flipping, right, to the opposite direction. So why is this so important when looking at drawn liquidity, right? So keep this in mind, guys. When a trend is formed, right, there's always, and I mean always, there's not going to be a time where liquidity is not formed, right? Because the market moves off liquidity, right? So you can use this strategy pretty much every day, like how I do, and how I put out the alerts and all that good stuff, right? So in this case, since the market went ahead and took out drawn liquidity right here, where is the next level of liquidity, right? Where would the next level of liquidity be at, right? Well, it's actually really easy, right? Since we already took out this level of liquidity right here, the next one is actually down here. Right, we have drawn liquidity at this low that the market created as the trend was being formed. You guys get what I'm saying? Right? So why is MSS so important when it comes to this right here? Well, it's actually really easy. Right? Since the market went ahead and took out drawn liquidity up here, and we have room to take out drawn liquidity to the downside, ideally what you guys would want to be looking for is a market structure shift. It's just a simple reversal from being bullish to being bearish, right? And this is the sole reason why the market goes up and the market goes down every single day, right? Because you might be asking, well, shouldn't everyone be buying to make the market go up? No, right? Because the whole concept behind this is that banks, they know that the market's going to go up, but before the market goes up, they're going to make sure that they don't buy at the complete top. They want to make sure that they buy at the possible bottom, right? So what's going to end up happening here is that once the market takes out drawn liquidity up here, right, an MSS model is going to start being formed, right? What's going to end up happening is the market starts reversing back down, and it starts creating drawn liquidity slowly until it takes out this one, right? Once it takes out this level of liquidity, right, all of us, right, the retail traders, we're going to end up getting stopped out, right? Or some people are going to end up gonna get stopped out, right? So what happens when they get stopped out? Well, like I always say, right, where there's a seller, there's a buyer, right? So us traders getting stopped out of our longs at the drawn liquidity level, which is where the market bounced from, which is where a lot of us are going to be placing our stop loss, right? We're going to be selling our orders over to the algorithm or to the banks, right? Once they get filled at the complete bottom and they're happy enough to make the market bounce back up, right, they're going to make the market start going up into the next level of liquidity, right? So how do you find these levels of liquidity again, right? Once again, guys, it's a rinse and repeat process. It's why the market goes up and down every single day, right? So what's going to end up happening here is you're going to be using every single pullback that the market created as it was going down, right, as drawn liquidity, or your price targets as someone was asking, right? You remember how I told you guys we use drawn liquidity as our price targets as well? Well, it's actually really easy, right? So in this case, now the market went ahead and took out this level of liquidity down here, right? We're going to be expecting a reversal back up. Now, keep in mind, it's not always going to be this case. It's not always the the easiest or the cleanest thing ever, right? Do I use an MSS indicator? No, bro, I don't use indicators at all. In my opinion, I don't think anyone should be using indicators, as they're pretty useless. In my opinion, they don't really help you all that much. They're kind of BS, right? But anyways. So in this case, right, now the market went ahead and took out drawn liquidity. Ideally, what you would want to be expecting here is now that all of us got stopped out and the banks got filled, right? They want the market to start going up, right? So how do we read this? Well, we're going to go ahead and mark out drawn liquidity right here. Wait, let me go ahead and make sure that everything is good here. Okay, so we're going to mark out drawn liquidity right here. We're going to mark it out right here, for example. Right here. And right here. So if the market were to start reversing and forming another MSS model, right, which will look somewhat like this, right? We form another MSS model right here, right? What's going to start to happen is the market, of course, banks got filled, all of us got stopped out, banks got filled, and now the banks want, of course, the market to go back up. So you start pumping billions of dollars into the market to start going up, right? So what's going to end up happening here is the market starts going up into these levels of liquidity, and it slowly takes each and every single one of them out one by one, right? And this is a sole example on how you use drawn liquidity as your TPs, or exactly how to read what the market is going to do in the future, right? So far, let me ask you guys, is everything making sense, right? For my beginners, for my experts, for my intermediate people, let me know if this is making sense, right? So drawn liquidity is pretty much where higher highs and higher lows are. Exactly. Pretty much you're just marking out every single pump, or like every single low or every single high before the pump or the dump, right? Just confused on drawn liquidity. Here, if anything, guys, this could help you out exactly, like, perfectly. Here, let me go ahead and find the level or the video for you guys, right? If you guys cannot understand drawn liquidity just yet, I have a dedicated video towards this, because of course I can't be stuck on the drawn liquidity topic forever, because I have to move on with the strategy, right? But here, guys, save this video for later. Maybe you guys might need it. For those that do need it, so we have to have a high and a low of the exactly, Bryce, exactly. When marking out drawn liquidity, are you using rectangles or lines? Lines. And I'm going to show you exactly why and when I use the rectangles. So just to understand, use the 1 hour time frame. No, like I said, you could use any time frame. It doesn't matter. You could use 5 minute, 15 minute, 30 minute, 1 hour, 4 hour, even the daily time frame. It doesn't matter. You're just pretty much marking out highs and lows in the market, right? And now here's one thing, guys. Sure, I can show you guys one thing as an example, and the example can be so perfect, but let me show you guys a real-time example on a play that I ended up catching last week that helped me get a payout on Friday, pretty much, right? So here it is, right? So I'm going to go ahead and delete all of this since we don't really need it, but I'm going to show you guys some real-time examples on it, and I'm going to show you guys multiple examples so I can show you guys that it actually works every single day, right? And it's super easy to read. So here, let me go and delete. Okay, so here we're going to be looking at the market right here, right? Now, I'm going to be looking at Wednesday's price action from last week. You guys might know that last Wednesday we had CPI news that pretty much came out, right? Here, let me go ahead and open up the chart right here. Okay, so here, let me drink some water real quick because I'm getting a little bit dehydrated. Okay, so let's go ahead and use Wednesday's price action as an example of my entire strategy. Right, so keep in mind, guys, we're going to be using, of course, remember, we're going to be using the trend, drawn liquidity, MSS, and of course, fair value gaps, right? So let's start off. Okay, right now it's a plain chart. There's nothing charted. We don't know exactly what the market is doing, and we don't know what it's going to do, right? So let's go ahead and identify what it's going to do by using the trend and, of course, drawn liquidity, right? So here's what I do on a day-to-day basis to pretty much identify what levels to use and pretty much see how the levels are going to react off this, right? But last CPI, yeah, no, it was insane. It was insane. Okay, so guys, the first thing you guys want to be able to identify in the market is where are the highs and where are the lows in the market. You guys need to be able to identify this because, of course, keep in mind, these highs and lows, they act as a magnet in the market. If you can't be able to identify it, you don't know when the market is going to reverse. You don't know what level where the market will go to, and so on, right? So in this case, we're going to go ahead and pretty much zoom out here, right here. You guys can see that pretty much in plain old sight. You guys see that the highest point that the market has gone to is in this CPI data high. At first, yeah, we had some drawn liquidity right here, right? But it's no longer valid because, of course, we took out this level of liquidity, right? So what we're gonna do in this case is we're gonna go ahead and move this level of liquidity over to this high right here, right? And of course, same way it goes with the downside, right? There's no level, or there's no bounce to the downside rather than this low right here, right? So we're gonna go ahead and use these highs and these lows right here as drawn liquidity, right? DayTrader, thank you, my man, thank you. Right, I'm gonna review that in a minute as well, right? So we're gonna go ahead and use this high up here as drawn liquidity, right? High, and we're gonna be using this low right here as drawn liquidity to the downside. Drawn liquidity equals low, right? And I'm going to put this over to the center and put this over to the center, right? So why are these two lines so important? Well, first of all, right, you guys can see that of course during when Wednesday's news came out, when CPI came out, right, you guys know that CPI has a lot of volume, right? The more volume there is in the market, of course, the more level of liquidity there is in the market. How far back to use when finding your trends? It doesn't matter. You could use, or at least for drawn liquidity, you can use levels from even a year ago and they'll still work as long as they haven't been taken out. Right, for the trend, I like to use the nearby trend. So depending on what the trend is today or yesterday, I will use that. I'll use that. Right, but okay, right. So in this case, we know that this is the highest point the market has gone to recently, and this is the lowest point the market has gone to recently, right? So what we're gonna do in this case is once the market opens up, we're gonna be waiting. We always need to make sure, and guys, write this down if you guys have to, right? Before the market, or as the market is opening up, before you guys take any trade, and for the people in my premium, you guys know that we always stay patient and we always need to make sure that price takes out liquidity first, always, right? So in this case, and this goes for every single day, guys, write this down if you guys have to. When the market opens up, make sure that it takes out at least one level of liquidity before you guys get into trading it, right? And I'm gonna show you guys exactly why, right? So now that we have the drawn liquidity high and the drawn liquidity low, what we're going to be doing is, of course, we're going to be waiting for the market to go ahead and open up. You guys might know that Eastern time, at least, the market opens up at 9:30, right? So at 9:30 right here, right, is when the market is going to go open up. So what I'm going to do is I'm going to go ahead and wait for these candles to go ahead and hit 9:30. Now, you guys can see right here, 9:30 finally opened up. What can you guys notice right here? Well, in this case, you guys can notice that price ended up going above this level of liquidity and it stopped everyone out. Now what can you guys pretty much take note of here? Well, you guys can take note that the trend was, at least short term, was semi-bullish as the market was getting bought up into this level of liquidity. Now that the market took out this level of liquidity, you guys might realize that it's pumping down, right? It's rejecting, it's going down. Why is this? Right? Well, keep in mind, CPI news came out at 8:30, hence why this candle was so big, right? This high up here is where people going into shorts, they set their stop loss, right? So what ends up happening is the banks, right, or the algorithm or the institution, whatever the case may be, like I always say, right, they're going to go ahead and manipulate the market to actually go above this level by a few points, or, you know, by a few dollars, by a few cents, depending on the market that you guys are trading, right? Once it goes above this level, all of the retail traders like us, and, you know, for example, like us, right, all of our short positions, we're going to go ahead and get stopped out. And like I always say, where there's a seller, there's a buyer, right? So when we're selling our short position, the banks or the algorithm, they're going to be buying our short position at the complete top, right? So what ends up happening is now that the banks, of course, they took out every level of nearby liquidity. As you guys see, if you zoom out, there's no level of liquidity other than this high, right? So the market, even if it wanted to go higher, it has no room to go higher because there's no levels of liquidity. There's no reason for the banks to pretty much make the market go up, because there's nothing to take out any higher. You guys get what I'm saying? The nearest level of liquidity, or, you know what I mean, the main level of liquidity is set at this high up here. If you, once again, if you guys zoom out, there's nothing nearby, right? This is the highest point the market has gone to lately, right? So what's going to end up happening is, since this is the highest point that the market has gone to lately, of course, there's going to be a ton, and I mean a lot, of orders or stop losses placed at this 163 level, right? So what's going to end up happening here is, once the market takes out this level of liquidity, right, the banks, they're not interested in taking out any other levels or stop losses above, because realistically, there's no stop losses above. There's no common stop loss above, rather than this rejection right here, right? So what ends up happening is, when all of us, for example, when all of us get stopped out, we're going to be selling our orders over to the banks, right? Now that the banks finally got their short orders filled at the complete top, what do you think they're gonna do after? Right? Let me ask you guys in the chat. What do you think the banks are gonna do after? Right? Let me see. Keep in mind, smash it down. Exactly. They're gonna go ahead, exactly like Alex said, like M2, Carson, everyone, right? They're gonna be targeting the drawn liquidity to the downside, right? Like I always say, think of this as a magnet. Think of this as a magnet right here, right? So ideally, what we're expecting the banks to do is push price eventually. Pretty much, we're gonna be expecting the price to go from being in a bullish market structure to forming an MSS model right here, which once again, it stands for market structure shift, right? We're gonna expect it to go from being bullish to being bearish, right? Once again, price or all of our orders, they got filled up here and they got filled over to the banks. Now that the banks got filled at the complete top, they want to go ahead and smash this down into the next level of liquidity down here, right? So what's gonna end up happening? Well, look at this, guys. Price simply goes back down into this level of liquidity, just like that. It can't get any more perfect, right? And I'm gonna show you guys exactly how I'm able to read this in the mornings, right? Let me show you guys a commentary from Wednesday, right? And the example isn't over, right? Let me show you guys right here, because there's a lot more to it, right? And the next example that I'm gonna show you guys is exactly how to trade these fair value gaps. I'm gonna show you guys how to catch these moves with the banks, so you guys can be trading with the banks and not with the retail traders. You guys don't want to be getting slapped out. You guys want to be playing with the banks, right? So this was on Wednesday, which was on the 14th, right? Okay, let me show you guys, right? So if you guys can, I'm sure you guys can see my screen share right here. Give me 1 second. Let me make sure it's screen sharing everything. Okay, right? So let me show you guys exactly what I read on Wednesday in order to pretty much predict what the market was doing, right? So I told everyone in the commentary channel, right? When CPI came out at 8:30, of course, NQ formed a data high and low, which created tons of liquidity, which acts as a magnet. Pretty much what I explained to you guys right here, right? What ended up happening is, of course, the market went ahead and took out this level of liquidity, and we're expecting price to go down into this next level of liquidity down here, as that is the overall market structure, right? So what are we doing here? Well, using the drawn liquidity magnet concept, it's safe to say that NQ is pretty much headed towards 19,000 on the dot, which is where, of course, the price is, the drawn liquidity down here, right? So how can we trade this? That's the next question. How can we trade this? Well, let me ask you guys in the chat, right? And I'm gonna explain this right now. Let me ask you guys in the chat. How many of you guys? What time was that? This was at 9:30, pretty much at market open, right? Let me ask you guys this. How many of you guys understand my fair value gap strategy? Because I know a lot of you guys do, but I know there might be a few people that are new to this that probably don't understand what a fair value gap is, right? So let me know. Let me know in the chat. And for my YouTube people as well. Let me see. Yeah, yes, I understand fair value gaps, but not sure about yours. I mean, well, I don't do anything different. Show an inverse. Okay, yeah, I'm gonna show that 300. I'm gonna show that. Don't worry. I'm familiar with fair value gaps, just not your strat. Okay, well, I'm pretty much explaining it right now. Let me see. Still learning. I understand drawn liquidity, but not fair value. Okay, perfect. Okay, so let me go ahead and show you guys pretty much a drawn example on what a fair value gap is, how you guys can find it, and exactly how it works, right? So, okay. Pretty much the whole definition behind a fair value gap is, think of it as an imbalance in the market, right? And I know this might be a word that a lot of new traders might not understand, so let me simplify it for you guys, right? Pretty much what a fair value gap is when the market, when the candle moves really fast in volume, or the candle is really big in size, right? There's going to be orders inside of that candle that have not been filled, right? So think of it like this, right? Let me ask you guys this. Right, for my options trader, I know this is a very common thing in the options market, right? Let's say, for example, you guys are trying to catch a very fast move or a very big move in the market, right? Sometimes when you guys place your order, sometimes you guys don't get filled, right? Let me know. Sometimes you guys don't get filled. That might be the case. You know what I mean? So what ends up happening is, let's say, for example, right? The market is really bullish, right? And it's safe to say that the market is really bullish. Or actually, let me say that it's bearish, right? The market is bearish, but it's not going down all that much. It's going down, but not in a crazy amount of volume, right? Perfect. Okay. So what ends up happening here is, let's say, for example, of course, not all candles are the same speed, or not all of them are the same size. Some might be bigger than others, some might be smaller, and so on, right? So right here, for example, let's kind of imagine that the candles are somewhat mediocre. They're small, they're whatever, but the market trend is bearish, so we know that the market is going down, right? So what is a fair value gap? Well, let's say for example, out of nowhere, the market ends up dumping like crazy, creating this huge candle right here, right? And we keep going down. So what ends up happening here is, of course, when the market goes down, a lot of people like us or like whoever the case may be, right? They're gonna go ahead and try to enter shorts or enter puts, whatever market you guys might be trading, right? But you guys don't get filled because price moved way too fast to the point where you didn't get filled where you were trying to get filled, meaning that your order is still out there in the market waiting to get filled if price goes back into the order or into the level that you guys were trying to get filled at. You guys pretty much get what I'm saying so far? Let me see. Can you show us another draw on liquidity? Yeah, I got you. Don't worry, Steven. I got you with another example. Yeah, okay, perfect. Right? So think of it like this, right? I'm gonna write it down right here, right? So price moved. Let me see it. Let me see if I can type. Moved too fast to where people put orders down, but never got filled. Right? Think of it as an area where no one in the market got filled, or a lot of people in the market didn't get filled. Right? Now, think of it like this, right? You guys know that. Think of it like this, like no one is left behind. Right? So what's gonna end up happening is price usually retraces into this fair value gap or into this space where no one got filled, right? It will go ahead and fill all those orders, and then price goes back down. Right? Do you guys get that idea? Let me know. Will it be saved? Yeah, here. It'll be right here. Right? So do you guys get this so far? Right? I'm trying to word it as simple as possible. Right? So pretty much think of it like there's a lot of orders in the market that didn't get filled in this range right here. Right? So I'm gonna go ahead and mark out the gap. This is known as a fair value gap, like this. So you're gonna mark it out just like that. Right? In this space, in this whole rectangle, right? A lot of orders didn't get filled. So what's gonna happen is the market is gonna pull back into this level, is gonna go ahead and fill everyone out because of course it's open liquidity in the market. You guys know liquidity must get filled. It's how the market moves, right? So the market, if there's a lot of levels of or if there's a lot of orders and a lot of liquidity in this space right here, right? The market will quickly push back into it. It'll be a small pullback, that's what it usually is. It will fill most orders and then it goes back down to the direction it was headed, right? This is known as a fair value gap, right? It's that simple, guys. It's really that simple. So let me show you guys a real-time example, or literally in the trade that we ended up taking on Wednesday, on exactly how you guys can catch the downside move with the amount of volume and the draw on liquidity, right? You're just mixing everything together, right? So, okay, think of it like this. Remember this example right here, guys, all right? So what's going to end up happening here is, first of all, you guys gotta understand, when you guys are trading fair value gaps, you guys need to make sure that the trend is aligned with the fair value gap. So if the market pushed down like crazy, right, you guys should be looking for shorts, and you guys need to make sure that the trend is bearish alongside with the bearish fair value gap, right? So in this case, right, we know that the market trend is bearish because we, of course, swept liquidity, we formed an MSS, and the market is going down to this level of liquidity. But before it takes out this level of liquidity, of course, like any other sane person, right, you guys want to be entering shorts. But where exactly can you get the best possible entry? Well, it's really easy, right? In this case, you guys can see, right, okay, first of all, let me make something clear right here. Let me ask you guys in the chat, how many of you guys trade futures? How many of you guys trade futures in here? Because I know a lot of you guys do, but I need to make sure that everyone does. Yes? Okay. So I'm seeing a lot of people in here trade futures, right? So that's a good thing, right? Okay. So when you guys are trading futures, you guys know that there's two futures or two indices that we trade. It's either ES or it is NQ. And for my options traders, NQ. Okay, here, let me write this down. Right? So NQ is the same exact thing as QQQ. Right? So if you guys see me trading NQ, you guys can trade QQQ and catch the same exact move, right? Now, ES on the other hand is the same thing as SPY. I know there's a lot of SPY traders and there's a lot of QQQ traders in here, right? Yeah. So if you guys want to follow my futures alerts, you guys can with, of course, options, right? You're gonna be trading SPY and QQQ, right? Okay. Now that we got that out of the way, right? When you guys are looking for fair value gaps, right? So I'm right here. When looking for fair value gaps, right, there's actually a point system, right, that pretty much based into my strategy that I use to find the perfect fair value gaps, the ones that have the highest chance in pretty much playing out, right? So how do you find this, right? It's actually really easy. So when you guys are trading NQ, right? So I'm gonna put here NQ. Pretty much what you guys are gonna be looking for is a 40-point candle or more on the 5-minute time frame or the 15-minute time frame, right? So what I'm gonna show you guys exactly what I mean. So 40 points plus per candle, right? To make, or pretty much to make a valid fair value gap. For ES, on the other hand, you guys know that ES doesn't move the same as NQ, right? So for ES, you're gonna be looking at a 10-point candle, 10 plus point candle, right? So what does this mean right here? What does 40 plus point mean? You guys might be super confused, or you guys might completely understand it, right? Well, in this case, the way you guys find points, pretty much what a point is the size of the candle, right? So what you're gonna do on TradingView, which I'm sure everyone in here uses, right? You guys are gonna be clicking on the measuring tool right here. It's under the smiley face right here, the measuring tool. You're gonna go ahead and click on this, right? Then what you're gonna do is, when you guys think is the contract system, no, because you're trading two different markets. You're trading one is futures and one is options. And I can't really explain that because it's gonna take way too long. So you just gotta watch the video on that. But anyways, right? In this case, what we're gonna be doing is, when you guys feel like you guys think that you guys found a fair value gap, it's super easy. What you're gonna do is you're gonna click on the measuring tool, grab it from the and actually it'll make your life so much easier if you activate the magnet and put it as a weak magnet, right? What you guys are gonna do is you're gonna simply click on the complete top, yes, including the wicks. Always include the wicks, right? Always include it, right? You're gonna go ahead and click on this complete top up here and size it down all the way down here, right? Where this number, where it says 50, right? If it's 40 or more, that is a valid fair value gap, right? And of course, you guys need to make sure that there's a gap in between the candles, right? I'm gonna show you guys that in a second, right? So this right here, right, where it says 50, you guys know that it's a valid fair value gap because it checks out with our 40-point fair value gap system, right? For example, let's go ahead and look at another candle, right? Let's go ahead and look at this one. This one, of course, won't be a valid fair value gap because if you measure it, it's only 16 points. So of course, you can't really trade this because there is no imbalance in the fair value gap, right? There's no imbalance here. You guys get what I'm saying, right? But when you guys are looking for candle sizes, on NQ at least, it should be at least 40 points or more, at least 40, right? And the same thing goes for ES. Of course, I'm not gonna look at it now because it's gonna ruin the whole replay feature. But you guys get the idea, right? So in this case, now that we know that this candle right here, we're paying attention to this one, right? So you guys can see right here, if you really zoom in, you guys will see that we have a very small gap right here, but it's still a valid fair value gap, because if you measure it just like this, right? Sure, it might be a small one, right? But we know that's valid because if you measure the imbalance in the candle, it's 50 points. You guys get it so far? Right. So what are we looking for here? Well, we know, we pretty much already, it's not guaranteed, but the probability behind the market going down into this 19,000 level, it's really, really high. Do I mean the middle of the, no, the whole candle itself, not the gap, the whole candle itself. It has to be 40 points, right? The gap right here, sure, it's a small gap, right? It's what, like 9 points? Yeah, 9 points, right? The gap doesn't matter, right? What matters is the size of the candle, right? So whichever candle you think is an imbalance, for example, this candle right here, it's a guaranteed imbalance. It's 84 points. So you might be asking me, why is this not a fair value gap? Well, you guys can't really mark this out as a fair value gap because if you guys look at the wick from this candle and this candle, there's no gap, right? When you guys are looking, yeah, it's no, the second candle always, Mac, the second candle, right? So for example, right here, right, we have an 84-point candle, right? 84 points, right? So why can't this be a fair value gap? You guys might be asking. Well, it's actually really simple. This candle or this wick right here cannot correlate with this one. So pretty much what you guys are looking for a fair value gap, what I mean by this is, hold on, let me go ahead and make this green so I can give you guys a good example, right? So background, okay. So let's say, for example, we have a bullish fair value gap, right? The bullish fair value gap will be this one right here, right? The whole reason, okay, there's a fair value and then the gap, right? What that gap means is the gap in between the three candles, right? So the gap would look like this, right? The candle size, sure, it's something that you guys pretty much need, right? But in this case, this will be the gap. Now, when this candle, for example, right, when it fills the body of the second candle, which looks like this, you can't fill out the gap anywhere because it doesn't exist. You guys get what I'm saying? Let me know if that makes sense. Let me know if that makes sense, right? So when you guys are looking at the 3-candle rule, you need to make sure that there's at least some sort of a small space in between the first and the third candle to mark out the middle candle as the gap. You know what I mean, right? So when you're looking at this one right here, right? You can't mark out the gap because this right here, these wicks, they filled the candle, right? So they pretty much filled the imbalance before the fair value gap was formed, right? But in this case, we have a space right here, right? So how can we trade this, right? Well, it's really easy, right? I'm gonna go ahead and put up the commentary channel right here so you guys can see what I saw real time and exactly how it played out. Right, so over here in the commentary channel, right, I gave everyone, you guys read it pretty much. I told everyone, yeah, I'm expecting the markets to go down into drawn liquidity as it looks really easy to read. It looks super easy to read actually, right? So in this case, pretty much what I told everyone is we're keeping an eye out on this 5-minute bearish rally gap on NQ. Why is that? Because first of all, we know that drawn liquidity is about to get taken out at 19,000, and we have a little bit of room to get some sort of a short position to catch a quick scalp to the downside, right? So what's going to end up happening is we're simply looking for a simple retracement into the small fair value gap, followed up with a rejection, right? So all we're looking for is a pullback into this space right here, right? A pullback which looks like this, right? Like this, a pullback, and then we're looking for a rejection into our price target, which would be at the drawn liquidity level. You guys know we use drawn liquidity as our price targets when we're entering these trades, right? So how did this play out, right? What are we looking for here? Well, pretty much what I told everyone is, once again, you guys want to be looking for okay, first of all, when you guys are using regular or trading, because I know someone asked me about inverse fair value gaps, which I will explain in a second, but when you guys are trading regular fair value gaps, you guys need to make sure that drawn liquidity does not get hit first before the fair value gap gets retraced into. You guys always write this down if you guys have to, right? Because it's very, very important actually, right? Because this will change the whole entire strategy, and I'm gonna explain why. You guys, it'll make sense in a second, right? So in this case, right, you guys always need to make sure that that the fair value gap, if you're gonna trade shorts off this bearish fair value gap, you need to make sure that price hits this fair value gap before it hits drawn liquidity, right? Because in this case, hear me out, guys, hear me out, and pay attention here because it's very important, right? When you're looking at a bearish value gap, right, and for example, drawn liquidity gets hit first before we retrace into this fair value gap, what's going to end up happening, right? Well, like I explained a million times throughout this entire class, right, what ends up happening is banks already filled the drawn liquidity to the point where they stopped everyone out of longs, right? Keep in mind, where there's a seller, there's a buyer. We're selling our longs to the banks, right? They buy at the complete bottom. Now, once the banks buy at the complete bottom, what's going to end up forming is an MSS model off this drawn liquidity level, right? When the MSS forms, the trend is going to be flip from being bearish to being bullish, and this 5-minute fair value gap is going to go ahead and get inversed and start going up into this level of liquidity up here, right? Does that make sense to you guys? Let me know, because guys, it's very important to understand that. Very important, right? Let me know if that makes sense. Yes, perfect. Okay. Why wouldn't it be an inverse fair value gap? Yeah, exactly, because we haven't swept liquidity. You always need to make sure that price sweeps liquidity before you look for an inverse off the fair value gap, right? So in this case, since we know that price hit the fair value gap before we hit drawn liquidity, we're going to still be looking for shorts instead of looking for an inverse to enter longs, right? So how's that going to look like? Well, we're simply looking for a simple rejection off this fair value gap, which is going to look like this, right? Once we get this rejection, I went ahead and told everyone, guys, this right here is a good space to go ahead and enter shorts and target drawn liquidity. So you will enter shorts off the rejection. You always place your stop loss at the highest point where the market rejected from. In this case, it'll be right here, right? You'll place your stop loss at where the market rejected from, and you target your drawn liquidity right here. So you're looking at a 1 to 2 risk reward ratio trade, right? And to spot liquidity swept is only at some low. It could be any level of liquidity. And if anything, if you need help with that, here, this can help you out a little bit, right? But this is pretty much how we ended up catching shorts. Now, I'm not done yet, guys. I know it's a little bit long, and I'm sure you guys might want to leave. I don't know. But here, in this case, what ended up happening is price finally hit drawn liquidity, and we ended up catching an 80. I'm pretty sure it's like 80 points, right? Keep going. I got you, guys. I got you. Don't stress it, right? So what ended up happening is price. Remember what I told you guys. Right? When you guys are looking at fair value gap, there's two ways to trade it, right? Remember what I told you guys in the list of the 4 things? There's either a fair value gap or an inverse fair value gap, right? When you guys are trading regular fair value gaps, you need, and I promise I can't stress this enough, you guys need, write this down, you guys need to make sure that drawn liquidity has not yet been swept. If drawn liquidity has been swept before we retrace into the fair value gap, once again, the banks, once it takes out liquidity, they're going to be looking to inverse the trend back to the upside, right? If the trend is bullish, of course, a bearish fair value gap will not work out in your favor. It's actually going to get inversed because the trend is against the fair value gap, right? And let me show you guys an example from this exact trade or this exact day that I ended up catching on Wednesday, right? Okay, so let's catch up here, right? So this trade is practically done. We ended up hitting a good 80-point trade. The trade is done, right? We're happy with our profits, whatever, right? Now, keep this in mind. When the market takes out liquidity, it's not, keep in mind, it's not always gonna happen. This is not always gonna happen, right? But usually there's a high probability that any level of liquidity nearby that gets taken out by the banks or by the market or by whatever, right? There's a good chance that an MSS will end up forming, right? So what we're gonna be looking for here in this case, right, is we're gonna expect an MSS to be formed and switch the trend from being bullish. Here, let me go ahead and rewrite this. Bullish, or no, from being bearish. My bad. From being bearish to bullish, right? So how is that gonna look like? Well, first of all, since this fair value gap kind of already got filled, we're not gonna be using this one, right? What wasn't? Yeah, it was on FOMC. Yeah, it actually was. It actually was, right? But I'm not gonna lie, it was by far the best example out there. The drawn liquidity is changed when it breaks the structure, right? In a way, yeah. As long as the higher low is created, that's where you're when your drawn liquidity is going to change, right? Okay, so in this case, right, you guys know we swept drawn liquidity right here and formed an MSS back to the downside. Now that this drawn liquidity got formed right here or taken out, what's going to end up happening is another MSS. What you guys would be expecting, right, is another MSS to go ahead and get formed right here, and the market starts going up. Eventually, it's not going to go up right off the bat, right? But the main idea is slowly for the market to slowly go from being really bearish to getting slower and slower as sellers are going away, right? And then to buyers take control, and then they take that control and of course gain the trend. Man, I love this. I love to hear, my man. And guys, real quick, before I continue, guys, if you guys want to show some love to the YouTube and join the community and all that stuff, guys, feel free to subscribe to the YouTube. I do daily live trading in there. I live traded today. We ended up catching the whole trade. Here, let me show you guys. It's like a quick plug. We ended up catching this entire trade on live for about 90 points. I caught this all on live. I don't know if you guys, of course, maybe you guys want access to the live trading and all that stuff, guys. It's all on my YouTube. So if you guys want, feel free to subscribe, show some love. It'll mean the world to me, guys. But anyways, all right, back to work. Right? Okay. So now that you guys know that price ended up taking out drawn liquidity and we're expecting a market structure shift and expecting the market to go up, right? First of all, we need to make sure that the market actually goes up. We're not going to waste our time expecting the market to go up if it doesn't, right? So let's go ahead and see what ends up happening here in the market after the market finally took out drawn liquidity at this low, right? Keep in mind, guys, here, let me open up the chat. Okay, YouTube, yeah, that is my YouTube. Yes, sir. Thank you, man. Thank you. Okay, so anyways, let's keep this going, right? So guys, the same reaction that we had up here, right? We're going to expect the same exact reaction down here, right? So what ends up happening here in the market? Well, you guys might realize that, hey, the market is starting to go up. Why is that? Because simply the banks took out liquidity to the upside, made the market go down. It stops everyone out, right? And then it goes down to this level of liquidity, stops everyone out. And like I said, guys, keep in mind, banks, they're geniuses. They're not going to be entering longs when the market is going up. They're going to be entering longs at the complete bottom that they possibly can. The algorithm is able to read this by looking at like a pool of liquidity in the market. Where's that at? Well, it'll be right here. All of our stop losses, they're all placed right here. Right? Exactly. Banks are always stop hunting, right? And there's a good reason they're doing that. They don't just want you to lose, right? They want you to lose to the point where they win, right? So you're losing by getting stopped out, and when you're getting stopped out, you're sending your losing order over to the bank so they could buy it at the complete bottom, right? Let me see. I heard fair value has get respected more on NQ. No, that's not a thing. They work the same exact way. They just have different reactions depending on the volume and the trend in the market, right? Some days ES is stronger, some days NQ is stronger. So keep that in mind. But anyways. But yeah, like I said, banks are, or like Gus said, banks are always stop hunting for a good reason, right? They want to make the money. Banks, of course, they want the power, right? And they do have the power to move the market like this, right? So what's going to end up happening here is the market finally ended up forming the MSS that we're looking for, right? And we're getting the bullish trend, right? So how can we trade this using an inverse fair value gap? right? Because I saw someone asking me in there in the chat, how exactly do I use an inverse, or like how do I inverse the fair value gap to use it into my advantage, right? Let me show you guys right here. Okay, so let's kind of catch up with what the market is doing right now, right? So I'm gonna go ahead and put this up here, right? So the new level of liquidity, right? Our new level of liquidity is gonna be up here, right? So we're gonna type this as our new of drawn liquidity, right? Our new level of drawn liquidity. Why is that? Well, it's because this is where the market, the highest point the market has seen before it dumped down, right? So as the market was dumping down, of course, there's always an active sellers and buyers, right? So as the market was dumping down, a lot of people entering shorts, they're gonna go ahead and place their stop loss at this high up here, which creates more liquidity that banks want to go ahead and take out as time goes on. You guys get that? Okay, perfect. Right? So what's going to end up happening here? Well, now we know that drawn liquidity got swept down here and the MSS forming bullish, right? We want to start looking for longs. But how exactly? We're not going to, okay, we're not dumb traders. At least I hope we're not, right? We're not going to be entering out of nowhere, right? We're not going to be putting an entry out of nowhere. You know what I mean? So what we're going to do is we're going to start looking for an entry by using the fair value gap. Wait, so we wait. Okay, you can either wait for a bullish fair value gap or keep this in mind, you could inverse a bearish fair value gap nearby. You get what I'm saying? Let me see. First setup, the highs and lows of when the market opens up. No, you could use any high and low depending on when the market is going to close, or it could be any high. It does not have to be right off open. No, it could be any high, any high. So in this case, yeah, we had a high right here off open. We took out the high and we created a new high up here. So this is going to be the next level of liquidity. You get what I'm saying? That's why I said here, our new level of drawn liquidity. You get what I'm saying? So yeah, it could be any high throughout the day. As long as the market bounced or rejected off that higher low, that's going to be your drawn liquidity. Yeah, exactly. Okay, so now we know that exactly that the market trend is bullish, right? How do we enter off this? Like I said, we're not going to be dumb traders and FOMO that the market's going up and we're going to chase these longs. No, we're going to get a spot on game plan, right? And exactly, yeah. So this bottom right here, we're going to go ahead and use it as drawn liquidity. Exactly. Right? So we're going to go ahead and delete this, right? Since it already got taken out, it's going to be a random level, not going to be useful anymore. We're going to go ahead and use this new level of liquidity down here, right? So spot on, exactly. All right, so you guys are getting it, right? I do like to see that. Okay, so let's go ahead and pay attention here, right? So there's one good way, or actually there's two good ways in entering this, right? So you guys might realize, right? The market trend is bullish and it seems like we're heading straight into 175, which is the drawn liquidity. So how exactly do we enter off this? Well, it's really easy. You guys might realize that on the 5-minute time frame, there's no fair value gaps, right? So what ends up happening when you guys can't find a fair value gap off the smaller time frame? It's simple. Just move up a time frame, right? Try to find a fair value gap off the 15-minute, could be the 30-minute, could be the 1 hour. In my case, I know a lot of you guys always ask for my time frames, right? I like to use the 5-minute and the 15-minute time frame as my entries, and I like to use the 1 hour to 4 hour time frame for my bias. Oh yeah, investor, bro. I've been explained it, bro. I've been explained it. But anyways, here, let me go ahead and check up something right here. Okay, so guys, okay, in this case, right, you guys might realize that on the 5-minute time frame, there is no fair value gaps anywhere, right? So what can we do in this case? Like I said, go up one time frame. If you guys can't find anything on the 5-minute time frame, try looking at the 15-minute. Maybe your luck is there to the point where, you know, you can find something. Hey, Brizzy, bro, have a good one, bro. Have a good one, right? Okay, so what we're going to do here is we're going to go over and switch over to the 15-minute time frame, right? Now, what are some stuff that you guys can see here? How many fair value gaps do you guys see in this chart, right? In the most recent chart, real time, what do you guys see? How many do you guys see? Let me see. One. Okay. Here, guys. Exactly. Bidoza and Lovely, right? There's actually two fair value gaps here. And no, I do not use the 1-minute time frame ever. It is not my my go-to. I do not like using the 1 minute. There's too much going on in the 1 minute, too much noise. It kind of gets me too distracted. I just don't like it. Right? Exactly. So guys, there is actually two fair value gaps here, right? There's actually a small, or not really small, but the gap is small, but the candle is definitely not small, right? There's a fair value gap right here, and you guys know that this is a fair value gap because first of all, if you measure the candle, it is way more than 40 points. It's actually 100 points more than 40 points, right? Or about 90, right? But on top of that, right, if you guys look at the first and third candle, there's actually a huge gap right here, or a small gap, not huge, a small one, right? So what we're gonna do here is we're going to go ahead and mark this out as a fair value gap. This is going to be known as this bearish fair value gap. Right now, on top of that, right, we have a bullish fair value gap right here, right, which is also a fair value gap. So two things can go ahead and happen, right? First of all, right, regardless of whatever happens, we're going to be bullish because we know that the market went ahead and took our liquidity down here, right? The market took our liquidity, swept liquidity, and we're forming an MSS back up. So right now, what this pretty much means is that our bias is bullish until this level of liquidity up here gets taken out. You guys get that so far? So regardless of the fair value gap, it could be a bearish one or a bullish one. Regardless, we are going to be looking for longs, right? And I'm going to show you guys exactly how to look for longs off a bearish fair value gap. It's really easy, actually, right? So two things can happen here. Either price retraces into this bullish one, right? And we get the bounce, same way, we get the bounce off this bullish fair value gap, and we go up into drawn liquidity. But if that doesn't end up happening, regardless, you guys will get a guaranteed entry. Why is that? Because we know that price is going to go into drawn liquidity, and above where price is at right now, we have a bearish value gap. So you guys might be asking, how exactly do you trade off this bearish one if it's a bearish one? I mean, should I be looking for shorts off a bearish one, right? No, right? Not in this case, because keep in mind, you guys want to be trading with the banks, and you guys want to be trading with the trend, right? Always keep in mind, if drawn liquidity has not been taken out, we still have room to go higher. Right? If drawn liquidity to the downside has not been taken out, we still have room to go lower. Exactly, the trend is bullish, right? So with the trend being bullish here and we have a bearish value gap, all we're going to be looking for here, right? And I already showed you guys step one. Exactly, the trend is your friend, right? Plan A would be either a retracement into this bullish value gap followed up with a bounce into drawn liquidity, or plan B, if this never ends up happening, right? Let's say, for example, the trend is really, really bullish, right? And it's so bullish to the point where we don't get a retracement. Plan B would be inversing this 15-minute bearish value gap. So how do you do that? Right? It's actually really easy, guys. Write this down, actually. Write this down. All you're going to be doing is you're going to be looking for a break above the selling territory. You guys know bearish value gaps. I'm explaining that right now. But anyways, bearish value gaps, think of it, the gap, inside this gap right here, this zone, this rectangle, think of it as like a selling territory. This is where sellers would ideally get active to where they want the market to go down, right? So keep this in mind. If buyers are a lot stronger than sellers and sellers can't get active where they're supposed to be, just imagine how strong buyers are, right? So we're going to be using this information to our advantage. We use this to our advantage by simply looking for a break above this bearish value gap like this, right? Just like this, right? And once we see that buyers break, hold, or close above this bearish value gap, that's going to be your cue, pretty much telling you that buyers are so strong to the point where the range where sellers should have been stepping in, they couldn't even step in there, right? Showing you guys that buyers have the full control, right? So once we have that checked out, that's going to be your cue to go ahead and enter longs, right? You enter longs and you simply target drawn liquidity up here, right? So how's this going to look like? Well, look at this. So in this case, right, what you're going to be doing is simply you're going to be waiting for a when you're trading inverse value gaps, ideally you guys want to be waiting for a close above the inverse value gap to get that confirmation that, of course, it's not a fake out, and it's not guaranteed, but it's confirmed that buyers are holding above it pretty strong, right? So in this case, we ended up closing up here, right? You guys see the candle close right here. So what you're going to do is you're going to be looking for an inverse off this bearish value gap since the trend is bullish, right? And you're going to look for an entry right here, right? Where you place your stop loss simply at where the market rejected from, which would be right here in this case, right? Then you're going to be looking to target up here. So in this trade, you're looking at a 1 to 2 risk reward, right? So for example, you're looking to risk $100 to make 200, which is beautiful, right? And what ends up happening right after? Well, peep this, guys. Boom. Your price target will go ahead and get hit right after, right? So now ask yourself, why did this trade end up playing out in our favor? Well, first of all, we know that banks were bullish, right? We know that banks were buying as the market was going up because, first of all, they bought at the lowest point, right? They swept liquidity and they ended up forming an MSS model to the upside, giving us that bullish trend, right? Now we know that the trend is bullish. Until when do we know the market will be bullish? Until, right? Actually, we know this exactly by looking at the drawn liquidity nearby. We know that the market wants to go ahead and take out this level of liquidity up here, right? So we're going to be using the magnet concept. Of course, as the market is going up, we know, or we're pretty much expecting the market to take out this level of liquidity above, right? Now we have that, we're going to be looking for an entry point, right? Keep in mind, let me write this down, right? You guys remember the 4 things I told you guys about, right? First one being the trend, second one being, of course, the drawn liquidity, which we have right here. Third one being the MSS, right? which is right here, right? We got the MSS, we have the drawn liquidity up here, we have the trend, right? And the final thing being, of course, your entry point, which is going to be the cherry on top to the strategy, which is going to be either the fair value gap, which would be could be this one, right? Or it could be the inverse fair value gap, which could be this one, right? You guys can use either or. Either or will work as long as you have the trend in your favor. You guys get what I'm saying? So these are the 4 key things that I use to my strategy to be, to have these $20,000 payout months or whatever the case may be, right? So you guys, and right now I'm pretty sure I'm not gonna lie, I kind of called it a day after this ended up playing out, but I'm pretty sure the market ended up sweeping liquidity and going back down. So look at this, guys. Look at this. You see what I mean? So we ended up sweeping liquidity right here again. And the market ended up rejecting. So this kind of shows you guys exactly how this plays out. How many funded accounts do I have connected? I have 13 funded accounts right now. I trade with 5 at a time. So when I request one payout, I will trade on the other 5. So yeah, exactly. So it's literally a rinse and repeat process, guys. I promise you guys. Matter of fact, it's not even that I promise you guys. Let me show you guys. Right. So look at this. Of course, here's the payout. Of course, all that good stuff. But look at this. For example, today, right? Let me show you guys the trade that we ended up taking today, right? And exactly how I use this fair value gap model or this entire model to catch the 90-point trade. So when we look at the chart, right? What are we looking at? Well, first of all, if you guys can look at my pic, I'm sure you guys see the picture, right? First of all, what we're looking at is we have liquidity down here. This is where the market dumped, found the bottom, and pumped back up, right? So this is going to be drawn liquidity, right? So what are we looking for? Well, first of all, we have a 5-minute bearish rally gap right here, right? Keep in mind, it is bearish. But before the market retraces to this bearish rally gap, what do you guys see? Well, you guys can see that the market ended up sweeping liquidity first. Now, keep in mind, if this candle right here never dumped down into this drawn liquidity, I would ideally be using this 5-minute bearish rally gap for shorts. But in this case, since the market went ahead and swept liquidity before it went into the fair value gap, we're going to be looking to inverse it because we're forming an MSS model going up, right? So what ended up happening here? Well, the market pretty much, we shoved liquidity, we formed an MSS, and we're inversing this 5-minute bearish rally gap. So in this case, ideally, you're bullish into drawn liquidity up here, and up here. Right, these 3 levels of drawn liquidity, right? So you're going to be looking to take longs and targeting these levels, which in this case, I enter longs off 610, right? Here are my price targets: drawn liquidity, drawn liquidity, and drawn liquidity, right? And of course, my stop loss will be placed out where the market bounced from, which will be in this case down here, right? What ended up happening after? Well, guys, peep this. All of our levels of drawn liquidity, they all got hit to the T, guys. Look how easy that is. You see what I'm saying? It's that easy, guys. And this resulted in a 90-point trade. And if you guys don't believe me, read the commentary. Right here, look, I'll show you guys for today, right? So right off open, I told everyone, for now, I'm liking the way buyers are holding up. If buyers do end up holding up NQ, right, and they show strength, I'll be keeping an eye out, drawn liquidity at 692, which in this case will be where the market rejected from, right here. And if you guys might be asking, how did I find this level? Let me show you guys, right? So I ended up finding this level on the higher time frame, which in this case was, let me see, it was 692, right? So it was going to be, let me see, 692. Or wait, hold on. I'm tripping, hold up. 692, so you zoom out. It'll be right here, right? So we have 717, right? If you guys zoom out, where is the highest point where the market went to before it had this entire sell-off? Well, if you guys really look right here, we have 2 levels of liquidity, right? We have this one at 692, right? And we also have this one at 717, right? These wicks right here, these 2 wicks, it could also be this one as well. You guys can also use this one, right? But in this case, we're going to be using 692, right? You guys see that the market took out this level of or we had to take out this level and this level. These 2 highs were the highest point before the market dumped down, right? So of course, if the trend is bullish, we're going to be looking to take out these 2 levels of liquidity, and if the market goes higher, we can use this one up here, right? So let me ask you guys: does this entire strategy make sense to you guys? Let me know, and let me catch up with the YouTube chat. I'm telling you guys, you guys know me. I've been doing doing these classes for months upon months. It's the same thing every day. It's the same thing. Hey, Mac, if anything, here, you could join the community through here. I don't know if you're trying to do mine or RPs, but if anything, you can find them here in my YouTube link. Here. Bro, I can't. But the chat's moving too fast. Hold on. Here you go. Here you go. The link will be in my description if you do want to join that. Is a fair value gap always after an MSS? Yes. No, actually, it's always after the sweep and then the MSS. And then the MSS. Here, Mac, if anything, here, I'll send you a friend request. There you go. There you go. And of course, guys, real quick. Guys, if you do want access to my because I do mentorships, and all that stuff, guys, if you do want access to the community and all that good stuff, simply send me a DM. I'll respond right after this class if you guys do need extra help or anything. You guys let me know, and I got you guys, right? But yeah, this pretty much sums up my entire strategy. A little bit, more detailed. You know what I mean? Here, hold on, Mac. Hold on. Let me send you this real quick. There you go. There you go. Mac, I went ahead and sent you the DM. How much is that? Hey, 300. Send me a DM, and I got you, bro. I got you guys. How do I? Okay, let me catch up with the chat before I Okay. Anyone using prop firms for these singles? Yeah, I actually use them. Aaron. I use prop firms when I take my own trades. Good stuff. Thank you. How do you use the 1 hour and 4 hour time frame to have your bias? Okay. You know that the 1 hour time frame and the 4 hour time frame can also have fair value gaps. But the thing is, which ones? Here. The thing is with the higher time frame, these fair value gaps take a very long time to play out because these fair value gaps are so big. Because of course the candles are huge on the higher time frame, right? So by the time they play out, it takes some time. So in that case, I just use the higher time frame to, like, for example, if we're bouncing off a bullish fair value gap, I'm gonna expect my bias to be bullish. You guys get what I'm saying? And so on. Here, Aaron. This should help you out. And then for the ones that are interested in my mentorship, guys, shoot me a DM. I will respond instantly once I finish this class. I got you guys. Shoot me a DM. Yeah, I do. New. Here. And then of course, if you guys want to try out the community, everything it's in my bio. Here you go. New. Here you go. What does the MSS stand for? It stands for market structure shift. Pretty much, let's say for example, the market goes from being bullish to bearish or from bearish to bullish. Think of it like that. But yeah, guys, once again, if you guys are interested in the group or the mentorship or anything, guys, send me a DM. I got you guys. I do more hands-on and all that good stuff. It's a 15-minute time frame too. I would say the 5-minute time frame is a lot better. I love that 5-minute time frame. All right, these live streams up on my YouTube? Yeah, they are. Here, let me go ahead and send you the link. Here they are. They're all recorded and all that good stuff. Even this one. But yeah, guys. Hold on, let me catch up with some DMs here. Let me see. Okay, there you go. Okay, got it. All right, guys. So let me see, guys. It's super fucking worth it. Hey, bro, thank you, my man. Thank you for the vouch. All right, is it a pair of Nasdaq? Oh, I don't know. Let me see. How long have I used the strat? For about a year and a half, I would say. I mean, okay, I've been trading support and resistance, which is kind of drawing liquidity for about 4 years. But I've kind of tweaked my strategy as I've gone on. But yeah. But alright, guys. Let me ask you guys: did you guys enjoy the class today? Was it good? Was it informative? You know what I mean? Was it all good and all that stuff? Let me know. Yes, sir. Bet. All right. So I'm assuming you guys are happy enough for me to. Can we use your? Yeah, you can. Mario. Yeah, you can. But yeah, guys. I guess I'm happy. I guess it will be a good time to call it a class for today, guys. So yeah, guys, it's been an amazing class. I'm really happy you guys were able to tune on by. Once again, if you guys are interested in the mentorship or in alerts or live trading and all that stuff, guys, shoot me a friend request, shoot me a DM. I will respond instantly. I got you guys. All right. But yeah, if anything, when I post this live on my YouTube, yes, I will. Yeah. Here. If you guys wanna get access to a live, it'll be right here. Bro, appreciate you, my man. Alright, guys, I'm gonna go ahead and call it a class for today. I will be doing one tomorrow. I'm gonna do one every single day this week. So I want to see every single one of you guys in there tomorrow. Alright, guys? Alright, guys, take it easy, guys. I'll see you guys tomorrow in the class. Alright, yes, sir, guys. Peace out. Take it easy. Peace. And for my YouTube, guys, amazing class today. It's all recorded and all that good stuff. But yeah, if you guys, of course, want to join the Discord, feel free to click the link down in the description. And I'll see you guys in the live stream tomorrow. Alright, guys? Take it easy, guys. Peace out.